Tired of chasing every market trend, only to feel like something's slipping through your fingers and you're still not getting ahead? Every crash, you panic sell. Every rally, you enter late. And every time you lose. The typical advice says read balance sheets, diversify, think long term, all fine. But all of that misses the most powerful tool available, human psychology. This video is going to show how to move beyond surface level FOMO and understand the real psychology of markets. How people sell everything in panic and buy everything in euphoria, and how to make money from that predictable pattern. Howard Marks in 2008, when everyone was running scared of bankruptcy, was investing billions. In 2021, when everyone was saying can't lose, he was quietly exiting. This isn't a game about products. This is a game about emotions. And emotions are predictable if you know what to look for. Let's start today. Let's start with GameStop, because it's the perfect case study for how emotions completely detach price from reality. January 2021, GameStop was a dying retail chain. Video game stores were closing. Digital downloads had made physical stores obsolete. The company was consistently reporting losses. There was no turnaround plan, no competitive advantage. The stock was trading at $5. Made sense. Then Reddit's Wall Street Bets forum got involved. They decided to punish the hedge funds that were shorting GameStop. This wasn't a financial decision. It was an emotional crusade. David versus Goliath. Retail versus Wall Street. Logic went out the window. In 1 month, the stock went from $5 to $483. The company fundamentally was exactly the same. No turnaround, no miracle, just emotions. People went crazy with FOMO. Reddit threads were spamming diamond hands and to the moon. Social media created a feedback loop. The more hype, the more buying, the more hype. This wasn't investing. This was collective mania. By the end of February, $40, an 84% crash. Billions evaporated. People who bought at $400 were down 90%. Howard Marks watched this entire episode and wrote a memo. He said this isn't new. This is tulip mania. This is the dot-com bubble. This is the 2008 housing boom. Only the packaging is new. Every bubble does the same thing. The narrative becomes so powerful that the connection between price and value breaks. People invest in the story, not the numbers. What was GameStop's story? We're sticking it to the hedge funds. Powerful story, emotional story, wrong story, financially speaking. But that's the power of human psychology. When the crowd runs in one direction, individuals shut down their logical thinking. Herd mentality takes over. Social media put this process on steroids. Bubbles used to take months or years to form. Now they form in weeks. Information spreads faster. FOMO triggers faster. Crashes happen faster. But the pattern is the same. Euphoria builds. Price detaches from value. Reality eventually hits. Crash happens. And here's the opportunity, because this is predictable. Emotions are predictable. Cycles are predictable. Howard Marks says when everyone's saying this time is different, that's exactly when you remember this time is absolutely not different. Human nature doesn't change. Greed and fear never retire. The people buying GameStop at $400, what was their analysis? None. Just FOMO. Everyone's making money, why aren't I? And the people panic selling at $40, what was their analysis? The same. Just fear now. Everything's falling apart. I'm getting out. Both decisions were emotional, not rational. This is the market's emotional roller coaster, and it runs in every market, every asset, every time period. Only the names and stories change. The psychology stays the same. Now let's talk about why this happens. Why smart people, educated people, experienced people make these emotional decisions. It comes down to cognitive biases. These are mental shortcuts the brain uses to make decisions quickly. They evolved to keep humans alive in dangerous situations. They're terrible for investing. Start with FOMO, fear of missing out. This is primal. Humans are social creatures. When the tribe is doing something, the instinct is to follow. In prehistoric times, if everyone's running, you run too. You don't stop to analyze whether it's a real threat. In markets, this translates to buying. When everyone's buying, the logic goes something like this. All these people can't be wrong. There must be something real here. I need to get in before it's too late. That's not analysis. That's herd instinct. Then there's the flip side, FOHO, fear of holding on. When the market crashes, the same tribal instinct kicks in. Everyone's selling. There must be danger. I need to get out now. Again, not analysis, just fear. Howard Marks talks about this constantly. He says the biggest mistakes in investing come from following the crowd. When everyone's optimistic, that's when risk is highest. When everyone's pessimistic, that's when opportunity is greatest. But doing the opposite of the crowd feels wrong. It feels lonely. It feels risky, because the brain is wired to find safety in numbers. Another major bias is anchoring. This is when the brain fixates on a specific number and makes all decisions relative to that anchor. Example, someone buys a stock, $100. It drops to 60. The brain anchors on 100. Now every decision is about getting back to even. If it gets back to 100, I'll sell. I'm down 40%. I need it to go up 67% just to break even. The 100 is irrelevant. The market doesn't care what anyone paid, but the brain can't let it go. Confirmation bias is another killer. This is when people only pay attention to information that confirms what they already believe and ignore everything else. If someone's bullish on tech stocks, they'll read every article about AI breakthroughs and innovation. They'll ignore articles about valuations being stretched or regulatory risk. The brain filters reality to match the existing belief. Then there's herd mentality. This goes beyond FOMO. This is about social proof. When everyone's doing something, it feels validated. It feels safe. The thinking goes, if Warren Buffett's buying, if Goldman Sachs is recommending it, if my neighbor made money on it, it must be good. But by the time everyone knows about something, it's usually late. The easy money's been made. What's left is risk. Market narratives play a huge role here. Humans are storytelling creatures. The brain doesn't process random data well. It needs stories with causes and effects. So when markets move, people create stories. The Fed raised rates, so growth stocks fell. AI is the future, so tech rallied. Geopolitical tensions, so gold went up. These stories feel true. They're satisfying. They make sense, but they're mostly wrong. Howard Marks studied this for decades. He showed that most market movements are just noise, random fluctuations. But humans can't accept randomness. Randomness feels uncomfortable, so the brain invents stories to explain it. And once a story exists, it becomes the model of reality. Decisions get made based on the story, even when the story is fiction. The dangerous part is that all these biases feel like logic. They feel like rational thinking. The brain doesn't announce, hey, I'm being emotional right now. It presents emotional decisions as logical conclusions. That's why smart people fall for this just as hard as everyone else. Intelligence doesn't fix cognitive biases. Sometimes it makes them worse, because intelligent people are better at building sophisticated justifications for emotional decisions. So here's where it gets interesting. If emotions are predictable, and if cognitive biases are universal, then there's a systematic way to profit from them. This is emotional arbitrage. It's not about finding undervalued companies. It's about finding undervalued rationality. Traditional arbitrage is when something trades at different prices in different markets. Buy low in one market, sell high in another, pocket the difference. Emotional arbitrage is similar, but the two markets are emotional states. When fear is high, assets are cheap. When greed is high, assets are expensive. Buy in the fear market, sell in the greed market. Howard Marks built his entire career on this. He calls it second-level thinking. First-level thinking is, what's the company worth? What's the growth rate? What's the competitive advantage? That's important, but everyone does that. It's priced in. Second-level thinking is, what does everyone else think? How are they behaving? What emotions are driving decisions? Where's the gap between perception and reality? When everyone's terrified and selling everything, that's not the time to join them. That's the time to ask what's actually changed fundamentally versus what's changed emotionally. 2008 financial crisis. Banks were collapsing. The global economy looked like it was ending. People were selling everything. Stocks, bonds, real estate, didn't matter. Just get out. Howard Marks looked around and said, wait, yes, there's a crisis. Yes, it's bad, but are all these assets really worthless? Or are people just panicking? He started buying distressed debt, beaten down stocks, real estate at massive discounts. Not because he knew the crisis was over. He didn't, but because the gap between price and value had become enormous due to panic. By 2010, those investments had doubled or tripled, not because he was smarter than everyone else, because he understood the psychology. The key is recognizing when emotions have pushed prices far away from fundamentals. That's the gap. That's the arbitrage opportunity. It works in both directions. When everyone's euphoric, when prices are disconnected to the upside, that's the time to sell or stay away. 2021 was like this. Everything was going up. SPACs, meme stocks, crypto, NFTs. Didn't matter. The narrative was money is free. Everything's going up forever. Can't lose. Howard Marks wrote multiple memos warning about this. He wasn't saying the economy was bad or companies were bad. He was saying the gap between price and value had become dangerous because euphoria had taken over. He reduced risk, sold positions, raised cash, not because he could predict when it would crash, because he recognized the emotional extreme. By 2022, most of those euphoric bets had crashed 50 to 90%. This is the long game. Emotional arbitrage isn't about quick flips or day trading. It's about patience, waiting for emotional extremes, acting when the gap is wide, then waiting again. The hard part isn't the analysis. The hard part is going against the crowd. When everyone's terrified, buying feels crazy. When everyone's celebrating, selling feels like missing out. But that discomfort is the signal. If it feels comfortable, if it feels like everyone agrees, the opportunity probably isn't there. Howard Marks says the best investments are the ones that feel uncomfortable at the time, because if they felt good, everyone would be doing them and the opportunity would be gone. Emotional arbitrage requires conviction, not in being right about the future. Nobody knows the future. Conviction that human psychology is predictable, that fear and greed create patterns, and that those patterns create opportunities for people willing to act differently than the crowd. Let's look at how the best investors actually use this. Howard Marks has been doing this for 50 years. His track record speaks for itself. During the 2008 crisis, when Lehman Brothers collapsed and the entire financial system looked like it was imploding, Marks raised $11 billion and deployed it into distressed debt. Everyone thought he was crazy. Banks are failing. The world is ending. And this guy's buying? But he understood something the crowd didn't. The gap between price and value had become massive because of panic. Companies that were fundamentally sound were trading like they were going bankrupt just because fear had taken over the market. Those investments returned over 20% annually for the next 5 years, not because Marks predicted the recovery, because he exploited the emotional extreme. Fast forward to March 2020, COVID hits. Markets crash 40% in a month. Again, total panic. Everyone's selling everything. Mark started buying again, not because he knew COVID would end quickly, because prices had disconnected from long-term value due to fear. By the end of 2020, those positions were up massively. Then 2021 comes. Everything's rallying. SPACs are going crazy. Retail investors are piling in. Can't lose mentality everywhere. Mark starts writing memos warning about euphoria. He's not buying anymore. He's raising cash, selling positions. 2022, market crashes. Most of those euphoric bets lose 50 to 80%. Marks preserved capital by recognizing the emotional extreme on the upside. Warren Buffett does the same thing. His famous line, "Be greedy when others are fearful and fearful when others are greedy." That's emotional arbitrage in one sentence. 2008, Buffett invested billions in Goldman Sachs and General Electric when everyone else was running. He got sweetheart deals because fear was so high that these blue chip companies were desperate for capital. George Soros has a different angle. He talks about reflexivity. This is the idea that market prices don't just reflect reality, they shape reality. When prices go up, it creates a self-reinforcing cycle. Rising prices create optimism. Optimism creates more buying. More buying creates higher prices. The cycle feeds itself until it doesn't. Soros looks for these reflexive loops. When he sees one building, he rides it. But he's always watching for the moment when the loop breaks, when reality reasserts itself. That's when he exits. All three of these investors, different styles, different strategies, but the same core principle. Markets are driven by human psychology. Emotions create extremes. Extremes create opportunities. So how does someone actually use this? Let's get practical. First, build emotional discipline. This is the foundation. If someone can't control their own emotions, they can't exploit others' emotions. That means developing the ability to stay calm when everyone's panicking and stay cautious when everyone's celebrating. Practical step: write down the investment thesis before making any decision. What's the fundamental value? What's the expected return? What would have to change for this to be wrong? Having this in writing creates a reference point when emotions spike later. Second, develop counter-cyclical thinking. This means actively questioning the crowd. When everyone's saying the same thing, that's the time to ask what if they're wrong. Not because the crowd is always wrong. Sometimes they're right, but when consensus is extreme, that's when opportunities appear. Practical step: track market sentiment indicators, the VIX Fear Index, put-call ratios, investor surveys. When these hit extremes, pay attention. High fear equals potential buying opportunity. High greed equals potential risk. Third, Identify sectors prone to emotional overreaction. Some areas of the market are more emotional than others. Tech stocks, small caps, anything with a hot narrative. These are where the biggest gaps between price and value appear during emotional extremes. Practical step: create a watch list of quality companies in volatile sectors. When panic hits and everything crashes, having a pre-built list makes it easier to act. The work was done when emotions were calm. Fourth, set entry and exit points based on behavioral flags, not price targets. Instead of saying I'll buy when this stock hits $50, say I'll buy when fear in this sector reaches extreme levels based on sentiment indicators. This shifts the focus from predicting prices to reading emotions. Prices are unpredictable. Emotions are more predictable. Fifth, have the patience to wait. Emotional extremes don't happen every day. Sometimes it takes years. The willingness to sit in cash and do nothing until the right opportunity appears is what separates successful emotional arbitrage from constant trading. Warren Buffett said his favorite holding period is forever, but his second favorite is doing nothing until the opportunity is obvious. The ultimate advantage here is understanding the human element. Everyone has access to the same financial data, the same earnings reports, the same news. What separates profitable investors from everyone else isn't better information. It's better psychology, understanding that when everyone's terrified, that's probably not the time to be terrified. When everyone's euphoric, that's probably not the time to be euphoric. Markets will always have emotional cycles. As long as humans are involved, fear and greed will drive behavior. That's not a bug. That's the opportunity. Let's wrap this up. The biggest money in markets isn't made by being smarter about products. It's made by being smarter about people. Howard Marks spent his entire career proving this. When crowds panic, the smart money stays calm and looks for opportunity. When crowds celebrate, the smart money gets cautious and preserves capital. This isn't about predicting the future. Nobody can do that. This is about recognizing patterns in human behavior. Fear creates selling. Selling creates lower prices. Lower prices eventually create value. That's the buy signal. Greed creates buying. Buying creates higher prices. Higher prices eventually disconnect from value. That's the exit signal. The gap between price and value, when it's driven by emotions, is the arbitrage opportunity. Here's what to do starting now. First, build your emotional toolkit. Write down investment theses before buying anything. This creates objectivity when emotions spike later. Track sentiment indicators so you can see when fear or greed hits extremes. Second, develop counter-cyclical thinking. When everyone agrees on something, ask what if they're wrong. The best opportunities feel uncomfortable because they go against the crowd. Third, be patient. Emotional extremes don't happen constantly. Sometimes the best move is doing nothing and waiting for the right setup. Cash is in a bad position when there's no obvious opportunity. The game isn't about products. It's about psychology. And psychology is predictable if you know what to look for. Most people will keep chasing trends and panicking at bottoms because that's what the crowd does. But now you understand the pattern. Now you see the gap between emotion and value. That's the edge. That's emotional arbitrage.